Are you into crypto and concerned about the tax consequences of being in crypto or how they might actually work? Well, my friends, I just spent this afternoon reading through the IRS's guidance on this, or the lack of guidance, as well as their note here and their FAQs to get a better understanding of where the IRS stands on this. And I wanted to talk about that. So we gotta understand the fundamental thing when we talk about basis and how things are taxed. So we're gonna do that first. Then we're gonna take a look at how staking might be taxed. And I say might be because there's really not that much guidance from the IRS at this point. Remember, cryptocurrency has only been around for 13 years or so. So we've got staking. Second, providing liquidity. How could providing liquidity be taxed? And third, loans, right? The three areas that are interesting to me, I figured I would do a video on because I have to have a talk with my accountant soon, and I'm going to have to explain this to her to get a better idea of what her perception of what I'm doing is. And if you're in a similar spot or just want to understand more of this stuff, then you should stay listening. But first, I want to make it abundantly clear that I am not an attorney or a tax professional or a CPA. I'm a dude on the internet who enjoys this kind of shit. So if you think this is advice, then you should probably be the person that gets in trouble for doing dumb shit. Right? This is just for educational purposes that you can take and talk to your accountant about. After we talk about all those, then I'm going to give you my personal tax strategy that I'm going to be using, or at least the framework in which how I'm going to be taking things and presenting them to my lawyer, and more of a broad or like how one might position their tax strategy. So with all that being said, if this is your first time here, what's good? My name is Sam. For those of you who are returning, it's good to freaking see you. If you're returning and you haven't already pressed that like button and subscribe, what's going on, man? Leave a comment down below if this is your second time or greater. And for those of you who are brand new, if you're not aware, there's some links down below in the description if you want to support the channel, or check out my other social, whether it's Instagram or TikTok or Twitter. Very active on Twitter. So with all that being said, let's get into this video. I spent the last several hours reading through that stuff, and now I'm ready to talk to you guys about this. So in order to talk about these things, right, we got staking, provided liquidity, and loans. We first need to understand something because it comes up across the board for all three of these, or potentially could, right? Is the basis. What is the basis? So the basis for crypto is going to be like what it was acquired at. What price did you get your crypto at? Now, when we take a look at spending crypto, because the basis is pretty easy, right? Like if somebody sends you something for 10 bucks, then you acquired that at 10 bucks, right? Like if you have purchased some from Coinbase or something at a certain price, then that's the price you purchased it at. It's relatively simple and straightforward. But when you go through and actually spend that crypto to purchase a product or service, it's a little bit more nuanced, and I don't think a lot of people understand this, but it could actually cause you to pay two taxes. With the way the IRS views cryptocurrency currently, if one were to take this $20 worth of crypto, say if that was the cost basis, they bought 20 bucks worth of crypto and they use that $20 worth of crypto to go purchase a product, right? What they can actually, that can actually cause them to pay two different taxes. And I'm going to show you exactly how. First of all, say the product's 18 bucks, right? And then there's something like sales tax. In other parts of the world, it's called like other things, right? But here in the United States, a lot of states have a sales tax that they have to pay when they go out and purchase stuff, right? So in this example, you bought $20 worth of crypto, you used the $20 to purchase this product. It was 18 bucks plus $2 in taxes, so that used up your money. Now, because how crypto works, right, the best performing asset class ever created, what if your cost basis for this crypto was 1 cent or a fraction of 1 cent? Then that would mean your cost basis, what you acquired it at, was virtually zero. So if you acquire this at zero and the current value of that is 20 bucks, then you go through and you spend that $20 to purchase this, you are also triggering a capital gain. So you have to pay 2 taxes. You got it for 1 cent or less, and now it's worth 20 bucks. You're spending that 20 bucks, and we'll just assume you gotta, like, as I mentioned, I'm not a tax professional, so you gotta do your own effing research and talk to your CPA or accountant. Assume it's 20%, all right, in terms of capital gains tax. So you take your 20 bucks, you spend it for your product. Now, you also owe $4 in capital gains tax. So that means you're paying $6 on an $18 product in taxes. You're paying, what is the math on that? That's a lot. 6, 18. Yes, 30+% in taxes to buy a product. It's crazy, especially, this is easily possible too with the amount of gains you see in crypto. You can have a 10x super easy, right? You can have way more than a 10x on things as over time, easy, and in a relatively short period of time, even 100x's and 1000x's. Now that we've got this taken care of, right? Because we really needed to understand this, because it's going to pretty much come up across the board for the rest of these things. See if I can move this over. Whoops. Or not. I'll just leave this here, I guess. Okay. Staking. So we're going to take a look at staking in Hex first, and then we're going to look at how other things might be staked. So in Hex, you have, and Hex, we'll just assume that it's purchased at the market rate today and then staked today, right? So there's not much change in the price, which means that you're not going to have like this capital gain, right? But if you had Hex and you had held it for a period of time, and that period of time the price is appreciated, then you could actually be triggering some type of capital gain potentially. Now, say you take this crypto that you purchased today and you stake it. Now you're burning that. Well, what does burning mean? Well, if we look at Investopedia, which is kind of like Wikipedia, their definition, which is not necessarily the IRS's definition, they can just make up their own fucking rules and we just have to play by them, right? While we live in the country and whatnot. If you burn a cryptocurrency, it says, what is burning a cryptocurrency? Cryptocurrency burning is a process in which users can remove tokens, also called coins, from circulation, which reduces the number of coins in use. So if the IRS chooses to use that definition, which is the most common definition utilized, then what could happen is, you say if you have $10,000 worth of Hex that you purchased today and staked today, then that could be a capital loss because you just got rid of your tokens. Right? That's pretty interesting. Pretty interesting. Think about that from a tax perspective. If you have a loss, you can use that to, capital losses can only be used to offset other types of losses, if I remember correctly. So you would obviously need to talk to your tax professional to understand what percentage of that or how that could be utilized to offset taxable gains, right, to reduce your tax bill potentially. Now, HEX, you just bought it and staked it, and you created a potential capital loss by doing this. Then you put it out, say, 2 years into the future, right, at the HEX stake. And so you get your HEX in 2 years and you mint new HEX. Well, I think it was question number 8 in here. They actually talk about this. So here, does a taxpayer who mines cryptocurrency, for example, uses a computer resources to validate Bitcoin transactions and maintain the public Bitcoin transaction ledger, realize gross income upon receipt of the virtual currency resulting from those activities? The answer is yes. Yes, they do. So you effectively would be creating a capital loss, potentially, right? I'm going to use the word potentially, today, and creating a capital gain in the future, or not a capital gain, I'm sorry. You'd be creating income in the future. So income is going to be taxed differently than capital gains or losses, right? Or maybe you could actually define that as a capital something, other type of income, because if it's a capital gain, then maybe you can use that because it's tax less. When a taxpayer successfully mines virtual currency, the fair market value of the virtual currency as of the date of receipt is includable in gross income. So yes, it's going to be taxed at income tax rates, it looks like. So that would effectively, you couldn't use it as a capital gain. It would be gross income. So if you're, however much you're making, it's just going to be added to that, which is income tax is taxed at the highest rate. Like if it was, maybe if it wasn't burnt, or maybe if it wasn't minted, then it could be a capital, gain and then taxed at a lower rate or whatever. But that is what it is. Now, what happens if you use a different protocol that just allows you to stake it? Well, again, we have to recognize this again. Crypto to crypto is effectively this. You can think of this, right? So if you have a cryptocurrency with a cost basis of 1 cent and now it's worth $20, and you take that and you put it into a protocol to stake that, then you are effectively using that crypto. The IRS may choose to create this definition, and the same thing with tax, where you are putting in a cryptocurrency and then receiving a NFT or receiving a like a LP token type thing, or a representation of your position as the stake, right? So if you are putting a crypto into a protocol and receiving a LP or like a position type of token, I keep calling it an LP token, but like that type of token as a representation, or NFT as a representation of your position in the staking pool or staking protocol, then that can be perceived as a crypto to crypto exchange, which then this type of thing could potentially apply. Because you bought it for 1 cent, it's now worth $20. Now you took this $20 and you staked it, and you received this other thing in return, which the IRS may choose to say that that's a sale of one product, right? One currency, virtual currency from their definition, and receiving something else like an NFT or a LP type of token in exchange. Now, it may be a protocol where there's no thing in exchange, right? Maybe you just put it into the protocol and then you just earn fees in there, and there's nothing you have to do in the protocol like getting any type of thing in response. Well, then It may not have to deal with the crypto to crypto product portion of this type of tax that would cause a capital gain, but the proceeds or the profit, the yield, the earnings, the interest from that would be taxed as income. Right? So if you put the 20 bucks in there and then you earned another 20 bucks by having it in that protocol, that 20 bucks would be taxable income, right? So hypothetically, depending on how it's structured and depending on how the IRS chooses to define this, you could pay a capital gains tax if you're getting some type of token in response to putting your thing in there. Could be a capital gains tax and a income tax through this. Remember, at the end, I'm going to tell you how I'm personally going to justify this with my accountant, right? Let's move on to liquidity providing. And as you probably heard me allude to, if you're getting a liquidity token, if you're getting a NFT, right? Think of like Uniswap v2 or Uniswap v3 or Pulse X, you will, it may be perceived that you're having this thing again, crypto to crypto, because you're getting an LP token. You took something with a cost basis of X, right, and you sold it for another, this LP token, which is just representing your position in the protocol. Right? We don't know how the IRS is going to define this. We're not sure, which could be a capital gain tax you'd have to pay if the cost basis was zero. Same exact example that we just went through. Also, those earnings, right? So say you provide this in there and you bought it at 20 bucks and you put it in at 20 bucks. So even if the IRS chooses to create these like definitions that are not how reality is, which they do, right? So if you're like, well, that's not exactly how these things work, well, then you haven't had a lot of experience with the IRS. They also define a house going down in value, and you get to depreciate a house, and that's not how reality works. Like the IRS doesn't live in reality; they just make up your fucking rules, and then you have to live by them. If you're in the United States, if you want to abide by the law, right? So the earnings from your liquidity providing, in the example where if you put in 20 bucks that you purchased today worth of crypto, so the cost basis is at fair market, the earnings are sitting there unclaimed, right? So they could be taxed when they show up as on the account or on the pool page or on the page, the web app that shows, hey, you've made 20 bucks, right? Then they could be taxed then, or they may be taxed when you press the claim button or withdraw button from there. We don't know, but it's going to be taxed as income. Now, loans are also very, very interesting. We again have the same thing with the crypto to crypto, right? Let me just look at my notes here. Okay, so I put down liquid loans in Aave, right? But fiat.io is going to be Aave on Pulse Chain. When there's slight differences in these, and the differences matter on how some of these things are structured or how you want to justify this to the IRS. Let's start with liquid loans. So liquid loans, you're going to take your Pulse and you're going to put it into a smart contract, and then you're going to pull out USDL, right? So you're not getting an LP token in this case. You're pulling out liquid loans. They're USDL stablecoin, right? The IRS may say crypto to crypto exchange, and they may choose to tax that. It is entirely possible that could be how the IRS chooses to tax that. Now, we don't know what they're going to do, and liquid loans make it a little bit easier because you're not receiving a token in response like what you do with Aave. And like when you put in you're putting money in, whether you're earning interest in Aave or you're putting money in as to collateralize a loan, you get a token in response. I believe that's how it works over there. So that could be, again, the crypto to crypto, meaning the capital gain or loss could take place on that when you do that to borrow against it. And the other thing with Aave, if, from my understanding, I haven't really super deep dove into their protocol, but if you have an interest of a certain amount, you don't have to pay that interest, but that interest just gets added to your balance as time accrues, and that means that you move closer to liquidation. And that interest, right, that is getting added to your loan, or there may be a payment on there. I think fiat.io might be, that's how that one's structured. I don't know the specifics of it, but I believe one of the protocols is similar to that, with interest is you're either paying it or it is you're getting added to your loan balance. Well, that again is a crypto to crypto transaction where you're paying the interest in crypto. And I say paying the interest in crypto, but the IRS may choose to say that that's a crypto to crypto, meaning creating a capital gain if your cost basis is below than the current price, right? And that would, when I say cost basis below your current price, that's this scenario right here, right? You bought shit and it's gone up in value. That means your cost basis is below the current price. So if that's the case, that's how they could perceive that. Or they may choose to perceive it as a loan and that actually be a investment cost, right? Or, I mean, assuming you structure it as a business, right? It could be interest on a loan. I think that it could be how they choose to do it. And you're like, well, that's how it is. Yeah, but when you deal with the IRS, that's just like, it's like a made up land, right? And it's like made up fairy tale land, just like crypto is. And they just make up rules that you abide by, and it doesn't have to have any or much of a basis in reality. It's just how things are done in taxes. Well, now that we've gotten to this point, I think I'm going to go through, probably lost a lot of people, which is perfect, because now I'm going to tell you how I'm personally going to be going through and using justification to my accountant to describe how I will be doing this. So in terms of HEX, right, am I going to describe this as having a lower cost base or like a capital loss, because that would be a good thing from a tax perspective, right? So that's how I'm going to be structuring this and justifying this to my accountant, that I burnt my tokens and they are no longer in my possession. I do not have them anymore. I cannot get those back. I have to mint new tokens so that I have a capital loss. This creates crazy flexibility, which is amazing. Like, this is awesome, guys. This is amazing. But we have to get the IRS to give verbiage or to see it this way. So advocating for this, getting an opinion letter from a tax attorney, right, to help with the justification of this stuff is also going to be very helpful. Now, providing liquidity and the crypto to crypto. The crypto to crypto, there's not much you can do about that, right? If you buy HEX and you wait a while and it goes up in value and then you stake it, you might have a tax consequence, right? Especially if you're using that justification, because it's going to be congruent, right? So if you say, for example, I had $10,000 of HEX, I held on to it for a while, and then it went up in value from $10,000 to $20,000, and then I'd have to pay taxes on that $20,000 when I put it into a stake to create a capital loss, right? So I'd have to pay capital gains on the gain that I had, of $10,000, right? And then maybe I could offset that with the capital loss from not having those tokens anymore, right? See how like this could easily get very, very complex, especially for something that is so new that the IRS has not given guidance on yet, or has given very little guidance on. But I'm going to be, putting mine out as a capital loss, and then when it comes due, obviously I'll have to pay income tax on it. Providing liquidity, I'm going to be utilizing that as if you're towards the end of the year and I have earned but I haven't claimed it and I haven't received it, is how I perceive that, right? And so this is the justification that I'm going to be using, so that if it's towards the end of the year and if that's going to put me over a certain amount or whatever the case is to cause more taxes for this year, I can just wait till January 1st and then do it in the following year to claim the earnings from liquidity providing. The capital, so in liquidity providing, I probably should have talked about this earlier. If there's impermanent loss, right? Like you have two tokens, A and B, and A and B diverge in their price movement significantly, whether one drops in price or the other one runs in price, or both those things happen simultaneously, and you end up with all of one of the tokens. Well, when somebody puts money into liquidity providing, if that were to happen, right, then you no longer have one, so that would be a capital loss right there because all of that went away. So impermanent loss can actually be written off, and that is how I'm going to justify this to the IRS. Please don't, please talk to your accountant. Like, I'm not an accountant, and I'm not going to continue saying that. Like, you need to talk to your accountant on this kind of stuff. And with the loans, I think we all know how I'm going to do that one, like how I perceive them to be as a loan, so that I will be doing it that way, and I'm going to be also documenting all this stuff in the way I document them with the spreadsheet. If you have any type of software or things that you utilize or know about, please let me know down below in the comments, or jump over to Twitter. There's a link down below, and hit me up on Twitter and say, hey, check this software out or this other thing out or this website, because I'd be interested. Now, any of these transactions, there's also going to be transaction costs. So if you're doing this as a from a tax perspective, right, then the transaction cost to do any of these things you can use to write off. So if you paid $20,000 and there's Ethereum fees of $100, right, you can use that, right? It's a trivial amount, but it is still a part of the transaction. So you could actually go through and write that stuff off. I know this video has been probably a little bit vague on things, but I'm not 100% sure on these, and I'm literally reading off of the IRS's website and their guidance here, and my current understanding of taxes to do this. So hopefully this was helpful. If it was, take a second and share it with somebody else so we can grow the channel. If you want to help me, be my buddy. He bet me that I cannot beat his Twitter following by July 30th. He's got 14,000 plus followers. I'm at like 3,500. So if you are seeing this and you want to help out, you can jump down below to Twitter, press the follow button, press the retweet button. If you like fitness related stuff, you can check out the other YouTube channel that's coming up right here. And if you like Instagram and fitness related stuff, you can check out Instagram, also linked down below. Appreciate you, and I'll talk to you soon. Peace.